Wouldn't be surprised if we see stimulus checks this summer going into the midterms. Crypto is screaming right now. I mean, we've never had more tailwinds in our space, but if you're just talking about price, I think you need retail.
While most analysts were confused by Bitcoin's slump in Q4 2025 and Q1 2026, Barhydt points to the DXY, dollar index. The DXY has been climbing for 90 days, acting as a leading indicator that liquidity was tight. Bitcoin fell because the expected liquidity didn't show up. But now, as the rotation reaches an equilibrium, we are seeing the bottoming process take hold. For Barhydt, a wick down to $55,000 is possible, but the fundamental floor is established. The market simply hasn't front-run the inevitable printing yet. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
2 points are mutually exclusive. I'm not convinced that it's because of the war that it was falling or going up, right? I think Bitcoin is still a macro liquidity suck. And I think you're going to see this year significant improvements in the liquidity situation. We've got $1 trillion in debt financing, debt servicing we've got to finance. We've got $10 trillion in debt that we have to basically refinance. We were trying to do it last year at lower rates. They're going to do what they have to do, in my opinion, to get those rates as low as they possibly can. All of that equates to incremental significant money printing this year. I wouldn't be surprised if we see stimulus checks this summer going into the midterms, right? So again, to me, it just all equates to more money printing. I don't think Bitcoin is front running that yet. I don't think the market believes everything I'm saying yet. I'm probably have a little bit of a contrarian on that view. DXY is actually up the last 90 days, which is usually a leading indicator on liquidity. And I think that's why, Bitcoin fell in Q4, Q1 is the liquidity didn't come. And so I think Bitcoin has kind of stabilized in that, and I think it'll stabilize for a while in that kind of 65 to 90K range, which for the non-integrated people sounds like that's not a range. That's insane, right? But for our world, that's a range, right? And I think that's what we're going to see. We may see a wick to 55, but I wouldn't be surprised if the bottom is in. I think that rotation is kind of reached an equilibrium state right now. I think what's really happening is that retail money is nowhere to be found, and retail sentiment in general for the overall investing environment outside of prediction markets and short-term bets is very, very low. And so I think until we see significant money coming in from a government liquidity perspective or some other source of liquidity, I don't think we're going to basically move outside of that range that I mentioned. I think it's still I think crypto is still by and large a retail market. Everybody's, including Abra, is excited about the institutions coming, but even ETFs at the end of the day are an interface for retail to buy securitized versions of Bitcoin via their broker, right? And that's penetrated 15, 16, maybe 20% tops of the Bitcoin float, and the rest is basically, not securitized. And so I'm still convinced that we need retail if we're talking about price. If we're just talking about the dynamics and the value add of digital assets, smart contracts via stable coins, now tokenized equities, tokenization of real world assets, crypto is screaming right now. I mean, we've never had more tailwinds in our space, but if you're just talking about price, I think you need retail. Credit markets, my background is more in traditional, my capital markets background is more in traditional fixed income, but I would say I look at the leverage and I kind of follow the leverage when I think about the winding up and the unwinding of these things. And private credit and private equity basically are still in the kind of post-ZERP hangover headwinds. And that unwind hasn't happened because it hasn't needed to happen yet. In other words, if you're in private equity and you have a 10-year fund and you basically were able to raise a lot of money in ZERP, put that money to work, and you're in year 4 when that happened and you're in year 7 right now, you're still basically a few years away from being forced to take a write-down on many of those deals where you finance those deals at close to zero and you've got to refinance them at a number much higher than zero. that's when, the proverbial chickens come home to roost, in my opinion. And that's the leverage unwind that I'm looking at in those markets. And I do think there's going to be more pain to come there for sure, right? So look at the SaaS. The SaaS world has been decimated. Will it recover? Is it overblown? I'm not sure, but I can tell you that a lot of mid-cap CIOs are going to be looking at, Claude and other tools first and off-the-shelf SaaS second to meet a lot of their immediate needs, because they can develop and prototype things in minutes now. And so why would you be paying Oracle and NetSuite for things you don't necessarily need, right? I know you're doing this with your own tools that you guys have developed, right, for AI. So if you've made a lot of bets in private equity and SaaS that you haven't had any liquidity event for, and you're in year 7 of those 10-year funds, and you haven't taken a write down, that can get ugly real quick. Now, I don't know how those numbers affect overall GDP because they are private. But I can tell you that I have not seen a lot of public write-down or failures of these private equity funds, and I would not be surprised if we start seeing significant write-downs or failures of private equity funds. For years, it's been a very simple message. Whether we like the rules or not, tell us what the rules are so we can all follow the rules if there needs to be rules, right? And so we went from everything is a security being the rule, which none of us ever believed was the case in the first place, but it was more like, hey, you startups can't afford to fight us anyway, so everything's a security, right? I remember getting a request, I think I could talk about it now, it's been many years, from the SEC, where they basically gave our company a list of like 30 assets and said, can you please identify which of these are securities? And included Bitcoin, Ethereum. I said to my lawyers, I said, none of these are securities. They said, well, that can't be our answer. I said, well, what do you mean it can't be our answer? It's the answer. So they said, no, you got to list a couple as securities. I said, well, I'm not doing that. You go figure it out. And so at least now we're having an intelligent conversation about what a digital commodity is, right? What a digital security is. And the fact that something can be a digital commodity and you can raise money in a securities style offering, which may require disclosures. But selling that, digital version of a Pokemon card later may not be a security offering, just like selling Pokemon cards is not a security offering. Somebody has finally come to their senses and documented that. And that is really, really good news for our space. Probably on the order of importance of the Genius Act itself for stablecoins, because this affects thousands of potential digital asset projects that are out there that needed that clarity. And I'm also not 100% sure they would have done this if they didn't think that the Clarity Act was coming, because they want all of this to be consistent. So to a certain degree, I think they're actually front running the Clarity Act itself, which is also good news.
Yeah, it's kind of like they were, it's like a parent whose kid is learning how to ride a bicycle. Yeah. And you're kind of running alongside it. You kind of, hey, go here, right? Okay.
Right.
But the kid thinks that they are riding the bike by themselves.
Yeah, but you know where the bike's headed and you can steer them. That's a great analogy. I totally agree with that.
Yeah. And was there any downsides or things that you saw in there that you were actually worried about?
No, honestly, no. I think they did it. Was so far, I've read it. I've also had, my internal AI read it, compared it to our own, thoughts on the matter. And I've been shocked at how useful, accurate, and well done this has been so far.
Now that we have it, does the Clarity Act matter more or less when it actually gets done?
Okay, so I have a different feeling on the Clarity Act. My opinion on the Clarity Act is not necessarily about the nuanced details of how we deal with stablecoin yield or this or that. My biggest concern, and I've been very clear about this publicly, is we need a regulatory moat around the digital asset space that makes sure that everything we're codifying now stays the way it is, regardless of who is in power in the White House, right? Who is running the Senate Finance or Banking Committee? Who is running the Ag Committee, right? We can't basically be changing our stance on what's a digital commodity and what's a digital security every 4 years because we have a different person in the White House who's putting different people in power. Mm-hmm. So we need to codify what they're saying, not just as policy, but as law, right? And Chevron, I think, I'm not a lawyer, but I believe Chevron also makes this clear, right? They can be interpreting existing law today very, very clearly. But if somebody interprets that law differently, we're back at the courts again. And we need to codify this so that we don't have Warren Gensler 2 in 4 years, and it undoes everything that we've been working on for the last 18 months.
Barhydt predicts that within the next year, we will see tokenized public equities, like Tesla or SpaceX, trading on-chain alongside Bitcoin and Solana. These won't be separate accounts. They will be one unified, tokenized portfolio that you can borrow against in real time using DeFi. The RIA industry is currently facing a sea shift in talent, moving away from generalists and toward trainers, people who can teach a company's Jarvis to run FP&A at light speed.
The tailwinds in our space are real. Tokenization, stablecoins. We'll talk about wealth management and being in the wealth management space. We not only want to service our clients, but other wealth managers who need to offer digital asset solutions to their clients in $100 trillion market, right? So we believe that the headwinds we had before have now become tailwinds. I don't think the tailwinds are going to get any stronger than they are now, except maybe if we stop bombing other countries and World War III doesn't break out. But independent of that, the tailwinds are there. It's clear to us that as a public company, right, as a registered investment advisor with the SEC, we're now in a position to establish ourselves as the future de facto leader in this emerging intersection between the digital asset space and the wealth management space, which is basically on zero. Right? I mean, we use this phrase, get off zero, right? Well, the wealth management space outside of small exposure to Bitcoin ETFs is basically on zero. Most of them are still managing 60-40 portfolios, when everybody in our shared world thinks that that allocation is dead, that the 40 allocation makes no more sense, but that's where they still are. Why? Because they don't talk to their clients more than a couple of times a year, most likely, right? Or in some cases, maybe the client has passed away and nobody knows, who knows, right? But that reallocation or inheritance and movement of those assets to the next generation away from what I call the boomer money into, the next gen money is about to happen. And they don't want to use the boomer systems. They don't want the 60-40 portfolio. Most of them are like, what is this treasury stuff? I don't get it out of here. It's losing me money. Right? They're on Robinhood, they're on Kalshi, they're on the next gen platform. They're looking at crypto, right? So we're going to help that wealth management space get off zero. Okay, so I've been speaking to RIAs quietly for years, probably 5 or 6 years now. So I speak, for example, at Rick Edelman's events, and he hosts big RIA events every year. So I get to meet with them, and I've seen the transition. So 5 years ago, I'd be presenting, and the questions I'd get from the audience was, I really don't understand this Bitcoin thing. Can you explain it to me like I'm a 5-year-old? That doesn't happen anymore. Now the questions are, okay, so I have clients who are holding Bitcoin separately on a hardware wallet, and they're telling me that they want to borrow against it, and I don't know what they're talking about. Or like 2 years ago, when I was at one of the events, I was talking about next gen smart contract platforms. I said, I'm really bullish on Solana personally, for example, or bullish on Sui or Aptos. And last year, the year after, I'd have individual wealth advisors coming up to me. Oh, thank you for talking about Solana. I ended up buying some and I've done really well with it. I said, oh, great. What about your clients? And they were like, oh no, can't do that. I can't put my clients in it yet. I said, well, why not? And they said, well, it's usually a compliance legal decision within the company. Now we're having discussions with say, how do we do this? Right? How do we legally do this in a way that's compliant, because the demand is growing, right? And so that's a totally new set of discussions. My clients want to borrow against their portfolio. They want to earn yield on their digital assets. They don't want them on hardware wallets. They don't want all their equities over here and all their digital assets over here, buried in the backyard. They can't deal with that in their trust or for inheritance. And so we're already seeing that with our direct clients. So we validated that. We know that business model works and the demand is real today. That's our existing business. Now what we're saying is we're in a position for you to offer it to your clients as well. They're starting to get it. It's starting to resonate. Another way of asking the same question is, do we get to a world where the traditional model for custody of equities moves completely to digital? Are we in a model where therefore the custodians that an RIA would use are now completely digital, meaning they look more like Abra, right, than they do like, a Schwab, right? And I think the answer is all of it is going to move to be digital. So the question becomes kind of moot because every portfolio by definition becomes 100% digital assets over the next 10 to 15 years or sooner, right? It's just a question of how fast we can get, tokenized equities live in the US, deal with the clearing issues and the custody issues. I think you'll see tokenized public equities live in the US this year for the first time. And then after that, it'll simply be a question of how fast they get adopted by wealth advisors, and then how fast you can start to do custom portfolio construction within the wealth advisor space based on the fact that I have tokenized Tesla shares or soon tokenized SpaceX shares and Bitcoin, which is a token, and Ethereum or Solana, and they become one tokenized portfolio that I can build custom do custom construction around. That will be available in the next year, in my opinion. I'm making some assumptions that certain things will get figured out in the market. Could be off a little bit, but I think you're going to see a mass migration to tokenized portfolios over time. Why? Well, number one, you can borrow against, in theory, the entire value of your asset portfolio using DeFi. That's huge. Two, they trade 24/7, which is what people today want, right? Remember, when you buy Bitcoin in an ETF, you're literally buying an exchange traded product that trades 35 hours a week. Bitcoin trades 24/7. That's a problem, right? These models that we're talking about address that problem over time. Think about public markets and public market CEOs. Because I always say, follow the money. What's the incentive? As goes the incentive, so goes the strategy and the execution, right? Public market CEOs generally have a 4-year kind of incentive model because they receive stock, grants or RSUs, and they vest over 4 years. And so their actions tend to follow that model, right? The single best thing you can do besides making your numbers every quarter to drive up your stock price is usually to buy back your stock. And so, traditionally people who are on a 5-year, 10-year will look to buy back stock, in my opinion, as quickly as possible because they know it's going to drive the stock price up. In the RIA world, you have RIAs that are being bought and sold constantly. Why? Because the owners retire, partners retire. And so that changes things a lot in terms of how these companies are managed, right? So like when Edelman Financial Engines was merged into a private equity company, it was an amalgamation of two companies. And since they've bought a lot of little RIAs, and they do that because they wait until these partners or CEOs retire and they're looking for a home for what they're doing because they want to cash out, right? And so they usually cash out by looking for a place to sell or merge, or, they'll get payments over many years. And so I think this transition to, or the inheritance transition that's coming from the boomer generation, combined with this next generation of people kind of cashing out, is going to create massive consolidation within the RIA space. And there's also like 15 major platforms that are used in that space. None of them are AI centric today. That has to go. That has to be fixed. So there's going to be another wave of consolidation from a tech perspective where people is portfolio construction. So anyway, so massive changes afoot, in my opinion, in the whole wealth management space in this country.
With AI, how's it changing how you guys build the company internally?
Oh God, it's taken over. I mean,
Really?
it's fantastic.
Like in what way?
So development, like we prototype stuff in hours. We use the tools. Now, when you're developing stuff that touches people's money, the AI at Abra doesn't touch people's money today, or crypto or anything like that. But if we're developing new features, we're screaming. If we're testing, market messaging, and we want to run it, we can have virtual legal discussions, because as an RIA, you have a framework for marketing that's different from a money transmitter, for example. All of that we can test, right? And so I have a Jarvis I've built in my life that's fully integrated with every aspect of our business that can basically run analysis for me in real time. And I've opened it up to my exec team, for example, to be able to take advantage of. If you're not an AI first company, and you're less than 250 people, you're crazy because you're not taking advantage of the fact that you should be in a position to move literally 10x faster now than companies that have entrenched systems that can't quickly move to the AI tools, right? That's the key right now. Is small to mid-sized companies should be able to move on a dime, like switch on a dime right now, versus the large incumbents that are having raging debates and are afraid of the displacement that's coming. We're not afraid of the displacement. We need the help because we've always been running Abra hyper efficiently, right? One of the reasons I'm excited to go public, but I'm not looking to hire hundreds of people.
Yeah.
The next step is that comment you made about how hard it is. I think that's about to change, but we're still in that phase of it's really hard. So let me be specific, right? So if you install OpenClaw today, which I've done, and you want to give it access to your email, to your Slack, to have a voice channel, Telegram, text, WhatsApp, which I've done, but I've done it in a very locked down environment. It's most of that, and even my cloud drive, my local file drive, a lot of that is API based. Meaning there's no way to do it by just typing in, please access my Gmail. It can't do that, right? So you literally are going to, different cloud service providers and getting API keys. I've already lost half your audience, right? By saying that, they're like, well, I don't understand what Bill's talking about. That's going to change eventually because these services know that in order to maintain their client relationships, they're going to have to integrate with these AI agents by default. But right now, I have to do the work of creating that integration myself, maintaining it, and making sure it doesn't break, especially when you become dependent on it, right? So there's a couple of, for example, keys that I use that expire by default, and there's nothing I can do about it, which means every few weeks I have to go in and redo it.
Everything.
Yeah, and so now I think there's going to be a wave that we've proven the demand, and every LLM is looking to reproduce what OpenClaw did because they want to own those relationships to make those integrations infinitely easier for the layman, the mid-sized company. But I also think it's going to create a lot of demand for tech talent, right?
Of course.
And so I think there's going to be a sea shift in how tech talent is hired inside of companies. Yes, you'll probably see a fair amount of cuts, but it's going to be a reallocation into the people that can make these services and tools work and train the staff to become the trainer, people in support, people in finance who are going to basically train, their Jarvis on how to basically understand the finances of the company so that you can quickly answer questions and do FP&A at light speed, for example.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.